Welcome to Truth, Money, and Freedom, where we discuss everything about truth, money, and freedom with your hosts, Timmy Chonga and Dell, coming to you from our Discord server, also named Truth, Money, and Freedom. An invite to our Discord platform is linked below in the description for anyone to join in on the conversation. Today, November 14th, 2018, we welcome Maneco64, who is a unique YouTube personality who discusses the financial markets, cryptocurrencies, gold and silver, and the financial reset. His YouTube channel is linked below in the description. Before we bring in our guest, I would like to bring in Dell, my co-host. Welcome to the discussion, Dell.
Thank you. Thank you very much, TC. Yes, I'm just going to do a few thanks and some welcomes here before we kick off this interview. First of all, many thanks to Maneco for spending some time with us today. He has a YouTube. It's very active, 4 or 5 videos a week, and that will be fully linked up in the description, and I will drop in a link in the Discord channel for people to get linked up and sub to that channel. I highly recommend it. I listen to most of the interviews, most of the videos that he puts on there, and I encourage others to do the same. The second thing is to thank everybody for turning up in the live stream today. We have a fine crew out there, and can I just remind you, if you have some comments or some questions, plonk them in the Discord chat and I will bring them into the conversation. And then lastly, if you're on YouTube listening to this, you may feel like you've missed out on the conversation, but you haven't, because we have a live Discord channel. You can join there 24/7, and there'll be people in there that are more than happy to talk to you about all the things we discussed today. So without further ado, let's bring in Maneco. Hello there, Maneco. Would you care to tell us a little bit about yourself and your YouTube channel, please?
Oh, hi, Del. Yes, I started working back in the late 80s in Switzerland. I got my first job out of university. Well, it was like my first how can I say, real job, as you might say. I did do a little bit of ski teaching before I got that job after I left university, because it was hard to find a job right away. But it was with a small private bank in Geneva. And my bosses were, we managed all kinds of assets, but they were bond specialists. And that's why I've always been, focused on bonds. But also precious metals later on. And I worked there for a couple of 2.5 years. And then I was asked to come and join a friend of mine who started a desk in one of the big bond brokers in London. And that's how I got to London. And then I moved into financial futures and options, always focusing on the bond markets, but also doing all other assets. And then I worked as a futures and options broker till 2012. And then after that, the firm I worked for closed down the desk I worked at, and I decided to try to go on my own, and I bought into a pawnbroking franchise. That I ran that for 2.5 years, but it went well, but didn't really make enough money. On the high street in London or in the UK, or Main Street as you call it in the US, it's very hard for small business to make money. And I learned that the hard way. So I closed the business down. I tried to get back into the city, but it was hard after 2.5, 3 years out of the city. And so I decided to start doing YouTube videos. And that was like at the end of 2015. And at the beginning, I didn't really, it wasn't Maneco64, and I wasn't focused on what I focus now, but I just learned through watching other YouTubers what to do. and then I picked, what I knew best, and that's what I've stuck to for about 2.5 years. So that's my background. So basically, I try to talk to my viewers like I used to talk to my clients, who were mainly institutional clients. Talk to them about what the market was doing, what I thought about the geopolitics. So that's what I try to do in my videos, and people, the people appreciate that. The people on YouTube.
Absolutely. In fact, I was about to say that the education that you provide on your channel is very unique. You provide a lot of perspective on the bond market, and today, if you don't mind, I'd like to start the interview by asking you if you can give us a little bit of history on the EU and the Eurozone, and then basically if you could go ahead and define our terms between the EU and the Eurozone, and
Yeah.
just how it all got started.
Well, yeah, I think it's important to differentiate the EU from the Eurozone. Eurozone is the countries that have the euro and are within the European Union. And the European Union is something completely different because the UK, for example, even though we are getting out next year, we are part of the EU, but we're not in the Eurozone because we have our own currency, the pound. The EU evolved, after World War II in the 50s, and it basically was a steel and coal agreement between France and Germany. They're trying to work together closely, trying to avoid, the past 50 years of continuous war. And then, then Italy came along, and then the Benelux countries, then the UK, then Spain, and Italy, and it was called the European Economic Union. And then it became more and more political, or European Common Market, if I should say it was, but it became much more political, and it evolved into the European Union. And now there's over 25 countries, if I'm not mistaken. So it evolved from Europe wanting to, be more peaceful after World War II, and the main actors were France and Germany. Even though I think there's a lot of talk that the Americans pushed the Europeans into forming the European Union. That it was a globalist project as well, to have one country. And then, you have political union, and then they went for the monetary union, which was thought of as well back in the 50s, but it took longer to come along. The euro, basically, I think it was 1st of January 1998, or let me check here the year.
Maybe it was 99. The euro.
Yeah, it started trading. Yeah, 1st of January 1999, it started trading in the markets. You see, I remember trading stuff in euro, but you couldn't go to Europe and use euro notes or coins. You still had the old currencies, but they were fixed against each other at the rate against the euro and against each other. They didn't move anymore. And then in January of 2002, the banknotes started trading, and all the old currency was, retired. So yeah, that's and you've had smaller European Union countries from Eastern Europe join the euro. You have countries like Sweden and Denmark who are part of the EU but don't use the euro, like the UK. So yeah.
Okay, and in regards to that, we're the Eurozone, the euro,
Yeah.
the EU. This is not a body of elected officials, is it?
Well, the euro was run by the European Central Bank.
Okay.
So it's the central bank. The EU, I guess, is more complicated. They have a parliament, they have a commission, they have a president, they have a president of the commission. I mean, they elect a parliament, but apparently uh, as Nigel Farage said, they vote on stuff, but the vote is not binding. Usually it's the unelected commissions who make the decisions. So it's not very democratic. It's like a Soviet system, really, the European Union.
Okay, understood. I'll tell you what,
And,
if you
and it
don't
was
mind,
so, yeah, it was sold. I think in the UK they had a referendum in 1973 to join the European Common Market, as it was known then, and it was sold as a common market. But then it evolved into a political union, and that's one of the reasons why almost 52% of the people voted to leave the European Union, at the referendum in June 2016, because it's evolved into something much more than just like a common market.
yeah, it's involved with lots and lots of business regulation that is stifling to, for instance, small businesses are having a really hard time getting started in the Eurozone because of these regulations, I would think.
Yeah, but the thing I would say though, I'm not too sure in the UK if we do, when we leave the EU, and not the Eurozone, because the Eurozone is just the currency union.
I'm sorry. Yes, the
Yeah,
EU.
but,
Thank you.
But I don't I don't know if it's going to make much difference here in the UK. I don't think that it's going to be deregulated and businesses are going to flourish, because I think the same people uh, are going to be in charge. The big corporations. Big corporations, they love regulations because they can afford to, respect the regulations, while small businesses can't compete. So I actually, even though I'm not pro EU, I don't think in the UK it will change much. Yeah, the UK will be more sovereign than it was, but I don't think the politicians and the establishment we have here is going to make it so that government is smaller. So, yeah.
Yeah, it seems that government always seems to want to grow. And I'll tell you
Yeah.
what, we've got some questions coming in. But before we get to those,
Yeah.
I want to ask you about the euro currency itself, because actually this is something I'm interested in learning from you right now. When the euro currency was created and it was implemented in all these countries that joined,
Yeah.
the European Economic, Zone, how did the bonds work, Mario?
Oh, yeah, the
Did
bonds.
go ahead.
Yeah, well, I remember it really well because I started in the futures market in the early 90s, and we had the German government bond future, which is traded in Deutschmarks, the Bund. We had the Notional, which is the French franc government bond future. We had the BTP, which is the Italian lira government bond futures. I traded also the Bonos, which was the Spanish peseta government bond future. And those traded up until January 1999, they all traded in their current currencies. But what happened as people, realized that these countries were going to be part of the euro, like especially the, Portugal, Spain, and Italy, what happened is the yields on those bonds dropped massively because people thought, well, now we're going to have Italian government bond, but it's going to be in euros, so there's going to be a lot less risk. So they had what they called the convergence trade. So what people were doing is they bought loads of the Mediterranean government bonds, and they sold the German and the Dutch. And the rates actually got very close together because when I the 3-month interest rate in Italy was over 10%. But then, in the early 2000s, once the euro got going, up until, the European debt crisis in 2011, interest rates were almost the same, for Italian government bond or German. So that's what happened, they converged. There was in 1998, though, when there was the Russian default, and I don't know if you remember LTCM, the hedge fund that Jim Rickards used to work for. They had that big crisis. actually that convergence trade went the other way, and LTCM, they've been betting huge that on Italian government bonds, and then it flipped a little bit. Italian government bonds went down massively, and they they went bankrupt. But then the Fed bailed out LTCM, and then the Italian government bonds started resume converging. But yeah, from January 1999, all those bonds became denominated in euros. So overnight, instead of trading 4 different bond futures, we went to just trading the Bund, the German bond future in euros. And why was that? Well, because it was the benchmark, you see. So all the other government bond futures market kind of died off. I think you do have some BTP futures now, but they're not as important. So
let me ask you this then, using the Deutsche Bond or the Bund as an example, they had existing debt before they joined the economic part of the euro.
Yeah.
Did their existing debt get literally thrown into new bonds for the euro? How did that work exactly?
Well, they just priced it into euros.
They repriced it into euros, but kept the same debt. Okay.
Oh yeah, but that didn't change. No.
Right. Gotcha. Okay, that's what I didn't know.
Yeah, I think you can, if you Google, fixed rates of old European currencies to the euro. I think one Deutschmark became like, or I think 1 euro was one euro was one Deutschmark 90 something. And so what they did is they just took 200 billion Deutschmarks, for example, and multiplied it by the exchange rate, but it became a euro Bund, instead of Deutschmark Bund. But they just used the exchange rate that from January 1st, those rates were set in stone, and that's how they converted the debt.
Okay, I understand now. And I'll tell you what. Go ahead.
And they converted the debt, and then from then on the prices fluctuated. So the yields changed for different countries. Like right now, Germany, the 10-year Bund is less than 0.5%, I think, the yield, but in Italy is like 3.5%. But at one point they were almost at the same level. Mm-hmm. When people realized that there is some risk in holding Italian paper.
Yep.
Even though it's in euros.
Yep, and then we'll get into that a little bit later, as far as the Turkish bonds and the holdings throughout Europe, which is very dangerous. But I'd like to bring Del in real quick with some questions from the audience.
Yeah.
Yes, yes, I have a question here from Wandra, and he'd like to know your thoughts on the US bonds and who is actually buying the US bonds at the moment.
The treasuries, I guess the Russians and the Chinese aren't buying. So, I mean, who's buying? I would say the hedge funds who are offshore. So when you see Cayman Islands buying and stuff like that, or Ireland as well, I think Ireland is probably the big US technology companies who have their headquarters in Ireland. They buy bonds through there. And the U.S. banks, because regulatory wise now, for bank, it's very, how can I say, advantageous for banks to buy treasuries in the U.S. because they're not taken away as reserves, so they can buy as much as they want, with free money that they get from the Fed and earn something. And their balance sheet doesn't change. So I think a lot of the U.S. banks are buying it. Someone's buying it, but it's going to be hard because in the next 12 months or so, the deficit is going to be over $1 trillion. The Fed's selling about 600 billion from its balance sheet. And I don't think the Russians and the Chinese are very keen. Maybe the Japanese might be buying some. as well. The Japanese seem to always play along.
Okay, thank you for that,
Yeah.
Maneco. I
Yeah.
have another couple of questions that's just come in here. Has the massive wave of immigration affected German bonds in the recent years? Is a question from Buttercup here.
Immigration, well, I don't really think it's relevant for, for the, I don't see how that's relevant. I mean, yeah,
Well,
if
she
any.
may be referring to the stability of the government itself in the bond market.
Well, not in Germany. I think Germany has fiscally is very strong. Germany actually runs a budget surplus of almost 2%. So, like, I think yesterday their GDP number came out, or today, and the headline was that it was negative, but it was negative quarter on quarter. Year on year was 1.2%, which isn't bad if you're running a 2% surplus. So I don't think it matters. I don't think the German government has problems financing the immigration. I mean, if they're running a budget surplus, they're very frugal, the Germans, I would say, and that's why their bonds are, the benchmark.
Yeah, that makes sense to me, Maneco. I have one more question here from Wandering.
Yeah.
He's talking about European central banks repatriating their gold, and with the happenings in Venezuela, whether will have been made more anxious over this.
Yeah, I think you mean the like the Bundesbank, and they repatriated some gold from the Federal Reserve of New York, and it took like a few years, which was quite amazing. And apparently some of the gold bars they got were not bars that they had in their list. So it looks like the New York Fed was lending out German gold, and they had to go into the market and buy it. Venezuela, I mean, in 2011, they actually repatriated over 100 tons from the Bank of England, and it was at that time that gold went from around 1400 to 1900. So I think it had a huge impact because the Bank of England had to go out into the market probably and buy physical to give it to Venezuela. And at the time, the president was Chavez, and there wasn't any problem shipping it. Insurance problem. I think all the gold was shipped. I think the Venezuelan Navy brought the gold back to Caracas, and that was like 100 tons, I think. So this 14 tons, I don't understand why the Bank of England doesn't want to give it's the state of Venezuela's gold. Their excuse is that the current government in Venezuela is not acting in the interest of the Venezuelan people. But I would say that it's not the Bank of England's business to decide that. They're just holding it there for Venezuela. And one thing I said in one of my recent videos is that in 1938, the Bank of England actually allowed the German Reichsbank, which was under Nazi control, to actually take gold from Czechoslovakia, which they invaded. So the Bank of England actually gave the Czechoslovak gold at the Bank of England to the Reichsbank. So, yeah, I'm not sure what's going on. I think maybe, they're having a tough time as well with keeping the price down. And they're trying not to, if they deliver 14 tons to Venezuela, they might have to go into the market to buy real gold, because they might, even though they have some of their bars in the vaults of the Bank of England, they're all loaned out. So it shows maybe that the market is more leveraged than we think, because 14 tons compared to 100 tons in 2011 is not that much.
Mm-hmm.
Indeed. Back over to you, TC.
Thank you, Del. We covered a little bit about the euro currency and the Eurozone itself, but if you don't mind, I'd like to shift it into the Eurozone banking sector.
Yeah.
The health of the banks in the Eurozone and in the EU in general is in question. We could talk about Deutsche. We could talk about, oh dear God, I can't remember the name of the banks, and the two banks in Italy that seem to be constantly in trouble. But can you explain to us why they're in trouble?
Well, first of all, I'd like to say that it's not only the European banks that are in trouble,
Sure,
but it's
sure.
all the big banks that are called SIFIs, or systemically important banks. And
Yeah.
you can Google that list of systemically important banks. You Google that and you get a whole list of the banks that are basically too big to fail.
Mhm.
And, there are, let's see, about one, two, three, four, five, about 10 American banks.
Yep,
There's European banks. So it's not just the European banks that are in trouble. I would say the American banks are in trouble as well.
I agree.
But they've been able to patch things up regulatory wise. In the US, FASBA has been changed, the accounting, and in Europe is a bit more difficult because the regulation is not is several countries, you see, is not as unified as in the US. But yeah, Deutsche Bank is probably priced in already, in terms of being in
Yeah.
real trouble. It's like, but you just have to go through the list of these systemically important banks. And I can tell you, I mean, in France, it's all the banks that are even, primary dealers for the New York Fed. That includes European banks like BNP Paribas, Credit Agricole in France, SocGen in France, Deutsche Bank, Commerzbank in France, UniCredit Group in Italy, ING in Holland, Santander in Spain, UBS and Credit Suisse, Barclays Bank, HSBC, Royal Bank of Scotland, and even in Canada, the Royal Bank of Canada is part of the list. And in the US, you've got Bank of America, Bank of New York, Citigroup, Goldman Sachs, JP Morgan, Morgan Stanley, Wells Fargo. So in terms of the derivatives, I think that's something you also want to look into, isn't it?
Yes, absolutely.
Yeah,
Because I think Deutsche's derivatives, I've heard anywhere from 40 trillion to 70 trillion.
I think Deutsche Bank, yeah, I think the what I've got here, $47 trillion derivatives book. That was
Okay.
from a couple of years ago, but it could be a little more now, $50 trillion. But yeah, that is big for Deutsche Bank. But then, if you look at the Office of Controller of Currency, and I'm not trying to slag off the U.S. and the U.S. banks. I'm just trying to put it into context.
Sure.
J.P. Morgan Chase, the latest second quarter of this year data, J.P. Morgan has $73 trillion in derivatives.
I did not know that.
Citibank, 48. Goldman Sachs has 41 trillion. And Goldman Sachs is not even a very big bank like JP Morgan.
Yeah, their leverage is much higher, even though their derivative books are lower.
Yeah, and no, they have a huge derivatives book, Goldman Sachs, $41 trillion.
Yep, I mean lower than JP Morgan, for instance.
Yeah, but it's very leveraged. Yeah, Goldman Sachs.
Correct. They're levered to the hilt.
The total U.S. Bank derivatives notional amounts is $206 trillion, and that's using what they call mark to model, which is a bit of a rosy way to look at it. I think it's a lot more than 206 trillion, and the BIS changed that kind of accounting after the crisis, so they allow them to market how they want to. So I think the exposure is probably more like 300 trillion. And if you look for the European banks, I've got an article here from October last year, and they supposedly have a 450 trillion derivative. That's the EU market. The thing is, this 450 trillion pounds it is. So it's about $600 trillion. That could include the American banks as well that, trade within the EU. There's more American banks in London than there are in New York. So, I think, yeah, European banks are in trouble, and also, the French banks, and they lend a lot to Italian banks, and let's say the Italian banks lend a lot to Spanish banks. I don't know if you saw a few years ago, there was like these two Australian comedians. They're talking about the crisis and how all these different countries, they all owe money to each other, and it's like a mess.
Yep. And I'll tell you what, can you define for us, if you would, the systemic risk throughout the system when the banks actually tether themselves together through these derivatives? And why is it bad to have
Well,
so much derivatives, and then also the leverage on the derivatives?
well, derivatives basically allow banks to bet on an underlying asset, but what they do is they abuse it. They bet on it millions of times. It's like your neighbors starting a market and start betting on the value of your house, and then you get people from other cities come and bet hundreds of times over on the value of your house. And that's what they did in 2007 and 8, the credit default swaps. And it's all right when the market is functioning and there isn't a major move. But if the market collapses, uh, you start getting what you call counterparty risk. So you might make a right bet on your house. Let's say your neighbor bets on your house, but the guy who took the other side of the bet can't pay your neighbor. He will lose everything. So that's why derivatives work well. These notional amounts of hundreds of trillions are not a problem when the market is not moving. But once it starts moving, and underlying assets start moving around massively, yeah, you can have the counterparty risk. And once, like Goldman Sachs, they made the winning bets in 07, 08, but they didn't get paid, so they were going to go bust, even though they
Yeah.
made win bets. That's what happens to derivatives.
Mhm.
I recommend people watch The Big Short, that movie, and
That's a
that
film.
plays really
Yep.
well. Yeah, yeah.
So basically, with the derivatives spread out across the banking system,
Yeah.
uh, what kind of gyration in the market could actually set off a derivatives crisis again that could actually threaten the entire banking system again?
Well, I think the biggest, you know, kind of derivative is interest rate derivatives.
Hmm.
So if short-term interest rates start moving around a lot, that could start it. 3-4% moves in underlying assets. Especially if you're leveraged 30 times. 3%. That's 100% right there. So yeah, it doesn't have to be like more than 10%. You could, volatility as well. Yeah, that's why the central banks are always, like the ECB and the Fed are always so careful, at their meetings to talk about, interest rates. I saw that Japan said recently, the Bank of Japan, that they're looking to stop, all the quantitative easing, money printing. But then they said, however, we plan to keep interest rates low for as long as possible. You see,
Right.
that's why they have to do that. Like the ECB, they're going to stop QE this year, but they said that they're going to keep rates as low as possible until at least next summer. So, and that's why the Fed as well raises interest rates. They telegraph everything and they do little by little, quarter of a percent. Because if they move the market too much, it could disrupt all the. And the thing about derivatives, the biggest derivatives are the over-the-counter derivatives. They're not traded on exchanges. They're traded. Banks call clients call the banks, and the banks write a contract for them. So there's no way to keep track of it. Uh, they've tried through the regulations to keep track more of over-the-counter derivatives, but it's not. So it's not transparent at all. And I've heard now that the Fed and the Bank of England, they're worried about a new kind of derivatives called leverage loans. So, that's the bankers, and they know that last time when they abused the system, they got bailed out, and they don't care if the system comes down again. So they're doing the same things, in my opinion, that they did before the '08 crisis. Even if they don't get bailed out, the bankers will, they'll get big bonuses and they'll take it out of the system before it all implodes. So that's why I think nothing has been done really to change the system. It's even worse now, I would say, than in '08. Excuse me.
Yep. I agree with you. They're definitely getting more creative in creating products, Wall Street products and banking products.
And they always create derivatives behind it because they make a huge amount of fees with derivatives. It's like, if you sell someone an ounce of gold, you get maybe, a 2%, you get $25 commission. It's not interesting. So what they do is so I'll sell you you can have a future on 1,000 ounces, so they'll get more fees. So that's how they think, the bankers. They always want to, someone, a corporate treasury might come to them. Oh, we want to buy these bonds, safe bonds, and then the guy, let's say at Goldman Sachs on the treasury desk will tell the treasury guy, oh, why don't you buy this derivative? It will give you. You don't have to you only need to put 5% of the cash down, but you have the same exposure as if you owned, 1 billion of these bonds. And then they'll get huge fees from that. Like vanilla, bonds, that's how they call it, cash bonds that are not derivatives, are boring, and they don't provide fees for the bankers. And that's why they love derivatives. They get the fees from the clients, and also they trade these things and can, a small move, because of the leverage, can make a lot of money.
Yep, I understand that too. And thank you for doing that, by the way, for explaining to us, the systemic risk that exists throughout the entire system, not just the Eurozone banks, but the banks worldwide.
Yeah.
By the way, I had no idea JP Morgan had that kind of leverage.
Oh, they do.
I had no idea. I always thought that that Deutsche was carrying more derivatives, than anyone else in the entire world, any other bank in the entire world.
No.
But when you look at systemic risks like that, realizing this is the entire banking sector, this is where all the money comes from and goes to. Let's talk about risk management for a second. For a healthy portfolio, and I realize that you're not a financial consultant. But what would you consider a good risk management hedge, considering the risk that is within the system? By the way, this touches on stocks as well, of course. But I know that you're into gold and silver and crypto. Would you consider having those in a portfolio to balance it out?
Oh, yeah, definitely. I think, I think it was Jim Sinclair who said, if you have physical gold, 5 or 10%, even though I don't think that's enough. But if you have 10% of the value of your stocks that you have in the stock market in gold, if the stock market were to crash or collapse, gold will protect that as a way of hedging. I guess the other way of hedging is to have options, put options, but those cost quite a bit of money, or ETFs. You have to keep options keep expiring, and then you have to keep rolling them over.
Not to mention margin calls,
That's right. But it's, hedging is kind of a result of the fiat money system. Because prior to 1971, I don't even think they used the term that much, because bond markets were more stable, so you didn't have to hedge bonds, your bond portfolio. But the other way to hedge is to be, if you're like a big investor, sophisticated, you might be long one security and short another through the futures. A lot of people do that. Use the futures. I did a lot of business for big mutual funds in Italy, and they always had a futures position, sometimes long, sometimes short, depended how their exposure to that stock index was. So, they would come in and sell because they didn't have exposure to the Japanese stock market. They would come in and buy 1,000 Nikkei futures. And then I guess, if they started buying Japanese stocks, they would start selling the future just to hedge out. That's how they use, futures is a good way to hedge, even though it can also be used to speculate.
Mm-hmm. And I'm going to talk to you a little bit about manipulation of gold and silver, because JP Morgan just got caught with their hand in the cookie jar again. And this isn't the first time they've been caught. So the last time we had a major story was, if I remember, it was Deutsche. And they were caught manipulating from 2011 all the way to 2015.
Yeah.
And the latest reports or estimates are they made approximately $4 billion rigging the price of gold and silver through the futures markets. And they went to court, and it was an American court, and their fine was $25 million, and one trader lost his job.
Yeah.
Seems to me it's very profitable to manipulate gold and silver.
Well, and I think these stories I saw the JP Morgan story and the Deutsche Bank story. I think that they do that just to tell, to show people, oh, look, we are punishing these people. But I think the manipulation is bigger than that, just a few traders. I think it goes, because if you look at the US when they started, allowed people to own gold again in 1975, January 1st, 1975, was the first time since 1933. Guess what happened on December 31st, 1974? They launched the COMEX future, gold future. So I think it's, and why do they do that? Well, to make gold like a commodity, to pump and dump it, to discourage the public from actually buying physical, and to, and the media is part of that as well, like CNBC, Bloomberg. They talk about gold as if it was a commodity. They even say sometimes it's risky. So it's more than just a manipulation of a few traders, but I also think it's the central banks. They're involved. They lease out a lot of gold. There are people, old central bankers who have come out and said they were prepared to lease gold when prices spiked higher. But yeah, the traders they catch, there's those kind of traders, they're present in every market. But I think the gold manipulation is even something bigger. It's something done by the central banks. It's a way of making people think about gold not as money, but as a commodity. Even though it's a monetary commodity, they make you think about it as it's risky, like oil or wheat, and it isn't. But they make it look like that because they move the market around. So it discourages people from actually holding gold as monetary insurance. So
it seems to me that you could almost, not just banks and central banks, you could almost throw governments in the cabal, because it was a U.S. court that fined Deutsche $25 million for making $4 billion on fraudulent transactions.
Yeah, and the thing is, if we really wanted to stop the gold manipulation, it would be impossible because, the governments and the central banks are behind it because, the central banks act in the banks in the banks' behalf and the private banks, and the less gold, the less people focus on gold, the more money they can make in their fiat money system. And the governments and politicians, the more value fiat money has in relation to gold, the more they can print the money to borrow and buy votes. So the only way to stop it is when there's enough physical data from the public, and that they can't fight that because the public has central banks. I think they own about 30 tons of the 100. I think there's 160. Sorry, 30 million tons. There's about 160 million tons in the world. So they have a concentrated market, but if the public really wakes up and starts buying physical, they'll have a tough time.
Yeah, and I'll tell you what, we're coming close to the end of our time, but just earlier today, I wanted to ask you about the Brexit. Theresa May just came out and said
Yeah.
the Brexit is going forward. So I was going to get your thoughts on that.
Well, actually, before I came on for the interview, I was watching that. It's not really clear yet. I think today she had to meet with her cabinet for like 5 hours, and she almost couldn't get them to agree. Finally, she came out like late at night, and she said, "Oh, we've agreed to it," but she still has to convince Parliament tomorrow to vote on it, and we haven't heard yet from if cabinet members have resigned. So it's not out. She's not out of the woods yet. I don't think. So right now the pound has rebounded, but it could very well drop very quickly tomorrow if we get, news on that.
Yep. We also saw the U.S. indices go down today.
Yeah.
And I wonder if it's related.
Yeah. I think, when I was watching, and the pound is really weak. The Dow was down 250 at the time. And ever since she came out and spoke and said, "Oh, we've come to some kind of agreement with the cabinet," the Dow is rebounded 0.5%. Even gold had gone up to 1216 and it's now 1211. Even we're up 10 though today. Gold's doing well, and silver's up 15. So yeah, but the stock market in the U.S. doesn't look good at all. I mean, we've had lost 600 on Monday, 100 yesterday, and we're down 150 here. So
I'll tell you, Mario, I'm 47 years old.
Yeah.
And the way I've seen the stock market move since Trump came in, I've never seen before.
Well, yeah. Sorry, go ahead.
It's incredibly volatile.
Well, the other thing people forget, though, is that we haven't had that much of a correction these last few years. And, with the Dow, when he came into power, Trump, or won the election, it was around 16,000. Now we're at 25. So, 1% of 25,000 is 250 points. So the moves are going to look huge because, we're such elevated nominal levels. But it could get, we could easily see a, 2,000 point drop, in the day, I would say, because that would be about, because with it at 25,000, it's not out of the question. I mean, in 1987, we had the crash. I think it dropped 500 points, but at that time, the Dow was under 3,000. So that was 20%. If we drop 20% now, that 5,000 points.
Yep. It's just a scary thought. It's but also too, we've got the Exchange Stabilization Fund here in the States. It's run out of Treasury, also known as a plunge protection fund.
Yeah.
So they run in to save the day quite a bit. We see that happen actually home real time when you're watching the market some days. But I don't know how, and by the way, how Mike Maloney likes to talk about how the markets move together. You can clearly see that if you see the markets. But that's my final question for you is, have you noticed that with the equities across the world kind of moving together?
Yeah, they do, because nowadays it's so much easier to trade. You don't have to call an exchange and call your broker. It's all done on the screen, and there's a lot of computer programs and algorithms, that people write. So they say if the Dow drops 1%, sell this and that. So they move together. That's true. Yeah. But, over the long term, for example, the FTSE 100, the UK index, it topped in 2000 at around 6,900. And now looking at it right now, it's at 7,000, 18 years later. So they moved together, but the Dow was at 11,000 back then in 2000, is now at 25,000. So it's kind of changing a little bit. I think the US is way overvalued compared to all the other markets.
Yep, I agree. There's going to be a day of reckoning at some point.
Yeah.
And it won't be pretty. And perhaps if the Brexit does finally happen, or they come out with a plan, maybe there'll be some corrections that happen in the indices worldwide.
It could be. I mean, I think today that showed a little bit because the markets looked a bit under pressure when she was in this cabinet meeting, and there were fears that her government could actually, collapse, and that would be like a mess. And it's still possible.
Yep, and I'll tell you what, we've run out of time, but I want to thank you so much for joining us today and give you an opportunity here to bring up any final thoughts you have and talk about your social media accounts. Oh, that's okay.
You're welcome. I enjoyed the interview and the chat with you guys and answering the questions. Yeah, my YouTube channel is Maneco64. Maneco 64. I also post my videos on steamit.com and on DTube. And I also tweet. I'm on Twitter at Maneco64. Yeah, so.
And we'll have all those linked below in the video on YouTube.
Yeah, I make I was away last week, so I only made 2 videos. But usually I make a video every day, and I do about 2 live streams a week as well, on top of the videos.
Mm-hmm.
Yeah.
And by the way, for anyone who has not seen Maneco do a video live stream, it is a lot of fun. I mean, he's answering your questions in real time, and I highly recommend you get out there for his live streams. Watch his videos on YouTube too; they're very, very good. And for someone who has the kind of knowledge he has, I'm just really honored to be able to have you on the show and get the history of the Eurozone and the EU. That was very nice of you. Thank you for doing that for us. And I hope that you'll come back and join us again for another interview.
Definitely. And you're welcome.
Okay. Thanks again, Maneco64. And we'll be talking to you again soon.
And thanks, Timmy Chonga and Doug. And thanks for having me. And I'll definitely come back.